Imagine earning millions of dollars every year without receiving a salary, without selling your investments, and without paying taxes on most of your wealth. It sounds impossible. Because for most people, making money follows one simple formula: work, get paid, pay taxes, spend what's left. But that's not how the richest people in the world build wealth. In fact, many billionaires intentionally avoid large salaries. They rarely sell their assets. Yet somehow they still buy private jets, luxury homes, and invest billions into new businesses. So where does all that money come from? The answer lies in one strategy known as buy, borrow, die. Today, we're breaking down exactly how it works, why it exists, and what lessons ordinary investors can actually learn from it. Let's begin. 1. The biggest lie about how rich people make money. Most people believe wealth comes from income. A bigger salary, a promotion, a larger paycheck. But income is actually one of the least efficient ways to become wealthy. Why? Because salaries are taxed immediately. The more you earn, the more taxes you pay. That's why many famous billionaires receive surprisingly small salaries. Warren Buffett earns only a modest salary. Mark Zuckerberg famously receives just $1. Elon Musk went years without taking a salary from Tesla. If they aren't getting paid, how are they becoming richer every year? Because they don't build wealth through income. They build wealth through ownership. Instead of collecting paychecks, they own businesses, stocks, real estate, and investments that quietly increase in value. Every time those assets appreciate, their wealth grows, without a single paycheck arriving. 2. Why the rich don't sell their investments. Most people assume that when wealthy investors need money, they simply sell some stocks. That's usually the last thing they want to do. Selling creates taxes. Keeping assets creates wealth. Imagine buying shares worth $1 million. 20 years later, they're worth $10 million. On paper, you've gained $9 million, but if you never sell, that gain isn't taxed. The government generally taxes realized gains, not unrealized ones. So while your investments continue growing, your tax bill stays at zero. The richest investors understand one simple rule: the longer you hold appreciating assets, the longer your money compounds. 3. The difference between good debt and bad debt. Most people experience debt as something painful. Credit cards, car loans, personal loans, student loans. These debts usually finance things that lose value. Meanwhile, the interest keeps growing. That's why consumer debt often destroys wealth. The wealthy use debt differently. Instead of borrowing to buy liabilities, they borrow against valuable assets they already own. To a bank, someone with a $100 million investment portfolio is one of the safest borrowers imaginable. Because even if something goes wrong, the bank has plenty of collateral. This is why wealthy clients often receive lower interest rates than ordinary borrowers. The bank isn't lending based on income. It's lending based on assets. 4. How banks give the rich millions without selling anything. Now comes the part that surprises most people. Imagine owning $100 million worth of company shares. You want cash. Most people would sell part of the portfolio. A billionaire usually doesn't. Instead, they walk into a private bank. The bank evaluates their investments, then offers them a loan using those investments as collateral. No shares are sold. No capital gains taxes are triggered. The investor receives millions in cash while still owning the assets that continue increasing in value. That's why many wealthy people can enjoy enormous lifestyles without constantly selling their investments. They're spending borrowed money while their assets continue compounding. 5. The secret behind buy, borrow, die. Everything we've discussed now comes together. Step 1, buy appreciating assets. Step 2, borrow against those assets whenever you need liquidity. Step 3, keep holding the assets instead of selling them. Eventually, those investments pass to the next generation. Under current U.S. tax law, many inherited assets receive what's known as a step-up in basis, which can significantly reduce capital gains taxes for heirs. This is where the strategy gets its name. Buy, borrow, die. For decades, wealth keeps growing. The owner enjoys access to cash, and taxes can often be deferred far longer than most people realize. 6. What ordinary people can actually learn from billionaires. Now, before you think, this only works if you're already worth hundreds of millions. You're right, most people will never borrow against billion-dollar portfolios. But the real lesson isn't copying billionaires. It's copying how they think. They don't chase income. They build assets. They don't buy things that lose value. They buy things that appreciate. They don't spend every dollar they earn. They let their investments work first. Whether your first investment is a stock, a rental property, a business, or even a simple index fund, the goal is the same. Own assets that become more valuable over time, because eventually your assets can start working harder than you do. 7. The wealth mindset that changes everything. The biggest difference between wealthy people and everyone else isn't intelligence. It isn't luck. And it isn't even money. It's how they view ownership. Most people spend their lives trying to earn more. The wealthy spend their lives trying to own more. Income pays today's bills. Ownership builds tomorrow's wealth. That's why every major fortune in history started with one thing: owning something that continued producing value long after the work was done. Conclusion: buy, borrow, die isn't a magic loophole. It's a strategy built around one simple principle: own appreciating assets. The larger those assets become, the more financial options become available. You may never need private bankers or $100 million portfolios, but you can absolutely adopt the same mindset today. Start building assets instead of simply chasing income, because wealth isn't created by how much money you earn. It's created by what you own. If you enjoyed this video, don't forget to subscribe. On this channel, we break down the strategies, psychology, and financial principles that help ordinary people think and build wealth like the world's most successful investors.